Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so we're live here with Matt Roberts at CMD Capital. Super excited to have him on the show today. Matt, can you hear me okay?
I can hear you great. Joel, can you hear me?
I can hear you, just making sure I got the right mic on. So I'm good. So
Cool.
Ready to jump into this. Everybody, we did not dress similar on purpose. It's just,
Great minds.
synergy, great minds. But today is the day for green. So, you've got a little bit of like a military green. I've got kind of like a forest green and I've got kind of the little turquoise green behind me. So that's a great way to kick it off. It's a great color. But let's get started, Matt. So tell us who you are. Tell us about where you grew up. I know you're in Toronto. So talk about your childhood, what your parents did, what you thought you would do in your career, and how you got to where you are. And I'll probably be interrupting you. In between.
Sure. So I'm Matt Roberts. I'm the co-founder and GP at Command Capital, CMD Capital. It's my partner and I'm here in Toronto. My partner's in Montreal, David. I grew up in Ottawa, which is the capital of Canada. So that'll be a little bit, one of those cities that nobody knows about, perhaps in the US, but it's actually the center of Canada's tech ecosystem, or it was for quite some time. I guess what was I doing as a child? Thinking I was going to do as a job. My dad was an electrical engineer.
I am too.
There you go.
I'm an electrical engineer by trade.
Oh yeah, same here. So co-founder of semiconductor companies in Ottawa. Some successful, some sadly not. So I always thought, I think if my father had been running a corner store, I would think that the next thing you do is a corner store. Because he was in startups and in early stage companies. I thought I'd be like, if you'd asked me at 10, I thought I was going to be an electrical engineer. By the time I was hitting 15, I was kind of thinking I'm less interested in the semiconductor side. I'd been doing reverse engineering of semiconductors as a sort of a teenager, a summer job at my dad's company and a few others, and realized that wasn't for me. So I went into software. And so I sort of boned up on programming at an early stage, and then I went to work for what was Canada's most successful sort of early tech company at the time, which was a company called Newbridge Networks. And I was the youngest manager there at about 19 years old, had about 4,000 or 5,000 people. And thought software and, telecom or something around that would be the space I go into, as an adult. And then the guy who founded Newbridge, a guy named Terry Matthews, exited Newbridge. He sold it for about, $10 billion Canadian. And he had a big family office. And so he said to me, hey, why don't you come work for me at my family office? And from there it became, I'm going to work in investments instead of software. So by trade, I guess if people ask me what technical background I have, I usually point at the programming side. But really, most of my professional career has been on the capital allocation side so far.
Sure. So what are some traits that you think form a good investor from being an engineer? What are some engineering traits that help you become an investor?
Well, I'm not a professional engineer like my dad was. I've noticed that, if I was going to say anything about engineers, it's similar to why you see many good venture colleagues from the law side, is that these are the only two vocations I know of where they explicitly teach logic, and how you build a logical conclusion and then tear it apart piece by piece. Engineers are forced to build logical answers and fixes to problems. Lawyers are meant to do it at sort of more along the discussion lines or thought processes, but both lead you to what are very healthy conclusions. That's why, Peter Thiel, for example, is a lawyer by trade, and he hires lawyers. He doesn't necessarily respect them, but he hires them anyways. And I think it's because you're seeing, You're seeing something. It's a trait that all engineers have to have in order to graduate.
Mm-hmm.
Oddly enough, they don't teach it as much in comp sci anymore. So I had to ask to take the logic courses that were available to engineers as a computer engineer. But I think that's why you see, engineers and lawyers doing, perhaps intuitively a better job at different vocations than their core degrees, right?
I do see parallels because, I mean, as an engineer, if you're an electrical engineer, there's like the concept of logic gates, right? So if this, then that, and like if you look at a typical term sheet or a legal document, there are triggers that get, or levers that get hit if something else happens. So I think sometimes that systematic process helps, translating at least terms to founders. And then I think also when you're diligencing, if you're in the deep tech space like me, diligencing just hard technology, maybe going to academics, going through research, trying to understand the technology very quickly, especially if it's like a new sector. Sometimes the technical background helps.
And you're dealing with people that are of deep backgrounds, and you're having to distill that knowledge, right? Mm-hmm. So I've always, because of my dad, I've always kept abreast of the semi side, and so which is quasi considered deep tech, I guess. And you can see the level of deep thought into the problems and the solutions they're trying to build are orders of magnitude better than what you're seeing as sort of somebody trying to solve a software problem, in a 2-week period, right? Right. So it's a different game.
Just as a history lesson, I'm wondering the timing of your father being in the semiconductor space. Because, I mean, obviously we all know about the traitorous 8, right? The group of 8 employees who left Shockley Semiconductor. So was it around that time or was it a little later?
So Canada. So my dad is British. So both my parents were from South Wales, in the UK. My dad was, he was finishing his master's degree in semiconductors and microelectronics in sort of 1968, 69, so quite some time ago. So the Traders 8 sort of had made their move, I think, by the time he'd graduated. Canada decided that it wanted to be a big player in semis in the late 60s, early 70s, and funded a company here called Microsystems International. And that was Intel's first international partner. So my dad was hired by Microsystems International, and Intel was their major partner. So he was working with the Intel guys in their first 3 to 5 years, and those payments from the Canadian firm, which was government backed, was the reason why Intel first showed their first profit ever back in 72, 73. So it's they were all sort of, I guess, common vintages. Maybe those guys were the generation right before, the sort of the 5 to 10 years before that, right? And the 70s was the sort of the time of the semiconductor boom, or the first semiconductor boom, I guess, if you will. It was like right along there. So my dad started his first company, I'm gonna say like not a few years after I was born, so early 80s, right? Yeah, around there.
Okay, got it. So it was a little after that, but it was definitely not fully mainstream, but it was just kind of slowly coming into the market.
Yeah, like for somebody who grew up in the ecosystem, or in like as the son of an engineer like yourself, like it didn't feel like this was the beginning. It felt like it had always been going for 20 or 30 years. But when you look back from where we are today, it looks like a very early beginnings, early innings in the tech ecosystem, and it was. It's just, you sort of get a better sense of how long it takes and how much it takes to really build these things and grow these things.
No, that's great. So tell me, what it was like to change from kind of the technical role to an investing role, and tell me how it was working for, whatever you're allowed to share in terms of the family office. And they always say, look, one family office is one family office, right? They're never
so it depends on, like, I've noticed, so I've worked with multiple family offices over the years, not working for necessarily, but worked with as LPs or other. And I thought I understood family offices because I'd worked at one for 5 years. I think it depends on who made the money and when, and then what the expectations and goals of that family office are. So in our particular case, Canada's most successful technology entrepreneur was Terry Matthews. I worked for his office.
Yeah.
Multi-billionaire.
Mm-hmm.
And sold his company for 10 billion, but he'd sold a company before that for over $1 billion,
Yeah.
20 years earlier. So he'd done this
Mm-hmm.
multiple times, and he was still, relatively young. He was sort of 60 years old when he exited Newbridge. So
Yeah.
it was not it was like, I was not dealing with the third or fourth generation. I was
Mm-hmm.
dealing with the guy who'd made the money and knew his ecosystem and his technology stacks and knew what he wanted to do. So he was not,
Yeah.
I was not dealing with like, third son,
Mm-hmm.
like trying to do something. I've noticed with other families where they're the generation after the founding member of the family office that those,
Mm-hmm.
they struggle a lot more
Yeah.
to figure out what they want to do with this and how they want to pay it forward into the next generation.
Yeah.
And then I've worked with people who are sort of fourth generation after the wealth creation, and you
Mm-hmm.
can tell that they're very far removed from decision making on a individual deal level, right? So usually the guy who makes the money, he's very involved in the decision making. The second generation is, trying to find their own path within the structure, and then the third, fourth generations are, some of them are doctors and they just do this like part time, and they've handed it off to professional managers to send them a dividend check every year, right? So they're not as
Yeah.
right.
What are some, let's talk about that for a second. How has that evolved over time? Some families now, I mean, the families that I know, many of them have a huge multi-asset strategy, right? So
Yeah.
they're, depending on the size, right? If they're 2 billion plus, they're not only doing venture, they're doing, a lot of times they're investing in the sectors that they know or that they've come out of, right? If they come out of manufacturing, they're investing in multi-decade durable companies, right? It could be a logistics company or a shipping company because they came from that industry. So, them buying those companies out, doing PE and buyout is a common theme, especially for families that were entrepreneurial for 1 or 2 decades. But they don't only want to just do buyout. They want to, expand their reach and invest in some venture, maybe explore maybe a hedge fund strategy because there's some liquidity. And then we see, private debt coming along too, especially in this time where, the interest rates are kind of high. So that's kind of what I've been seeing. I've been seeing a little bit of a multi-asset strategy, but it's dependent on their goals and also just kind of how big their asset size is. Whether it's 2 billion plus, they're going to almost act like an institution, right?
Yeah, I'd say it's so I raised money in the US, I raised money in Canada, I raised money in Europe, and I raised money in the Middle East,
Mm-hmm.
in the Gulf states. I think each individual region, even between Canada and the States, which you'd think are very similar,
Yeah.
the maturity of the family office structures in the US are well ahead of the rest. The Canadian ones, I think it's a function of just the size of Canada and
Mm-hmm.
dispersity of all of the population across the nation.
Yeah.
It's a very big continent, and it's a very small population, right? So you've got it spread much more thinly.
Yeah.
Um, and there's not many. There are, but there are not many more like 2 or 3 generation family offices that are structured that way. The ones
Mm-hmm.
that are you see them very much diversified into multiple assets for
Yeah.
yields, right? If you're in the Middle East, they're just now beginning to structurally decouple themselves from
Mm-hmm.
predominantly oil-based or resource-based investment structures. So they're trying to create yield outside of it and outside of the Middle East as they come to perhaps a time when oil and gas is less lucrative for them, or when it runs out, depending on which country we're talking about. In Europe, it's only now that they're beginning to realize that and I'm speaking predominantly of continental Europe. The returns are just locally, the returns are just not as good, and so they're well aware of that, and they're trying to internationalize those. For better or worse, that's been more focused on China to some extent, and that is now coming home to roost to some extent. When there was very little yield elsewhere, that China looked like a great game. But now that China's, persona non grata in some quarters, it's much
Mm-hmm.
more difficult for them to exit their structures as quickly as they'd like.
Yeah.
So there's a rethinking and people use the word decoupling, but I think it's more of a just, perhaps leaning further into the Western investment structures than going into, Asia and particularly China. And India's like the up and coming unknown place, right? So,
yeah. Tell me a little bit about, just the Canada ecosystem. So you talked about Ottawa. I know there's Toronto. I know, a handful of LPs on the West Coast, I guess, near Alberta.
Yeah.
So just tell me about, just educate us about the ecosystem on both coasts, and, maybe just kind of the sector focuses as well. I'm assuming huge B2B SaaS, consumer tech ecosystem, but we'd love to kind of unpack that and just understand the industry sector focus areas and the activity for us.
So in terms of where capital has been deployed, Toronto is probably number one today. That wasn't the case 20 years ago. There's just more deep tech, more labs, more deep technical experience coming out of Ottawa, where the research labs for the governments and Nortel and those telecom companies was located for a long time. Toronto and Montreal, to a lesser extent Alberta, enjoy some of the top rated AI professors and developers in the world. So Jeffrey Hinton is here out of Toronto, and Jeff would be considered the godfather of AI in the world today. He's the guy who was recently quoted in Time magazine complaining about where AI is going. And he speaks from a level of authority because almost all AI work today references his original work. In Montreal, there's an equivalent professor who's also done, a number of, he's sort of a contemporary of Jeff's. So Canada graduates the majority of, top flight master's and PhD level AI guys. So Jeff Hinton's lab here in Toronto, if you look at who's graduated and where they've gone, most of the top AI companies you're seeing in the world today came out of that lab. So the OpenAI team, about a third of them are all Jeff Hinton's team members or former team members or master's students and PhD students. They may have gone somewhere else for their undergraduates, but they all ended up in Toronto. And so we're seeing Toronto right now as that sort of big win. There's that in Montreal as well. Sort of a smaller factor of it, obviously, and then in Alberta as well. There's sort of things going on there. So Canada has that on terms of where venture capital is going. We have Cohere up here, which is doing quite well, it seems, on not a deal I'm in, but is sort of the anchor tenant on growing fast in the AI LLM space, large language model space. But they're doing it predominantly focused on corporates, so building LLM models for internal corporate use using their data, which allows them to, not necessarily share their data with other AI firms. And you also have essentially, when you talk about the capital sources in Canada, it's a very thin market. So for multiple reasons, Canada's the traditional LPs you'd find in the States, which are family offices, pension plans, corporates. There's just less of them all in the Canadian ecosystem. Pensions invest here. There's less family offices, and there's less corporates by the factor of what headquartered here. So there's less money in the ecosystem as a whole. So I think if you look at sort of population size to our American counterparts, it's usually about 12, 13 to 1. But the venture capital dollars is sort of 35 to 1. So there's just a lot less VC here. And it's not for lack of quality technical teams. I think it's market access, and to some extent, nobody's focusing predominantly on the Canadian ecosystem.
And tell me a little more about the goals of the family offices and the origin. It sounds like, I'm assuming in Alberta, a lot of them come from manufacturing infrastructure, oil. And
oil,
it sounds like
oil and oil services. You're not going to see a lot of manufacturing. So in Canada, the populations are each province is to some extent a city state. So Toronto being sort of the center of the Ontario, the province here, Montreal, that of Quebec, Calgary, that of Alberta, Vancouver, that of BC. And manufacturing predominantly is sort of anchored in the Ontario, Quebec angles. And that's generally because of the St. Lawrence Seaway. It's a geography thing. You can float a large boat up to Toronto's docks. You can float a large boat up to Montreal's docks. That's why you don't see it necessarily stuck on our coastal lines like you see with New York and Boston.
Sure.
And in the case of Alberta, they're resource rich in oil and gas, right? And so they're that is the anchor tenant of their economy right now. And so while they have other things going for them, the lion's share of it is oil and gas revenue, and the way they get it out, because they don't have, it's not on the coast, is through pipelines, right? Yeah, so that's their focus. So there's a lot of technology around oil pipelines. There's a lot of technology around oil and gas extraction, and mineral resource extraction. And there's just a ton of development going on in wireless as well there, and in AI. And the wireless side comes from the fact that they're right next to the Rockies, and it was very difficult for them to communicate with people in Vancouver because of the mountains. So they built a lot of wireless technology companies there over the years.
No, that's great. And then what are some of their goals? Are they looking to, are you seeing a growing interest for them to
there's
kind of get into the tech space?
the ups and downs of the oil and gas and the sort of the movement towards net zero,
clean energy, hydrogen,
right? Has sort of focused their minds on where they're going to be in 20-25 years, right? So they're setting the scenes and the investments for that. The government there, the province there is doing that, and you see that trickling into the family offices as well.
Sure.
But they're still also heavily focused on if you look at them, when I talk to them, they still feel over allocated in the oil and gas ecosystem. You'll still see real estate guys there who are not. But if their backgrounds are oil and gas, they're still heavily in the resources sector.
So I live in New York, right? So we're super, we have climate week here. We're super, green. We're all about, upcycling. I talked to a fund manager a couple of days ago, and that's essentially their whole focus. Now, if I were to talk about hydrogen energy and go out to Texas, I might get a different response, right? So how is like Alberta and the oil ecosystem responding to kind of the next generation of energy? Are they open to it? Are they open to kind of engaging with more opportunities to integrate in with clean energy sources? Or are they like, look, you know what?
No, I think there's two ways of looking at it. So if you're somebody sitting outside of Calgary, you'll hear a lot of rhetoric there that they're not super supportive of all the programs and systems that are being built. If you're actually in Alberta, in all fairness to them, they've done the best job of actually decarbonizing their existing oil and gas industry than most of the others in the world. And don't forget, the majority of the petroleum product that's in Alberta comes from tar sands. So it requires you to take in sand, essentially steam it to get the oil out of the sand, so then you can refine it. And that's very carbon intensive job, right? Because you're heating up hot water to get this tar and oil and separate it from the land, from the sand. Pardon me. And so there's a lot of work for them to decarbonize, and they've done probably the most dramatic job of doing that when you look at their numbers over the past 10-15 years since it became a priority. So they're very open-minded to these things. I think they are less enthused by government regulation over it. Right? And so I think Texas is the same. I think both of them sort of look at their central governments as not working with them, but working against them to some extent. And so sitting in Toronto, like, I can say, oh, they should do more. But when you look at the numbers, they've actually done quite well in both cases. But I know the numbers in Alberta specifically, so they're very open-minded to it.
And tell me a little more about like what you would advise new fund managers to think about as they're thinking about building a firm. And this is not, and I'm not talking about just a one-time, pilot fund. It's kind of like, thinking about a multi-decade career and essentially a franchise, right? So like, what advice would you give to someone?
Yeah, I'm 25 years in to venture now, or 20
Yeah.
years in. I probably note it, like look, and as I'm starting a fund and a franchise myself, I think about this daily. A lot of people are sort of our age. I guess we're approaching or at middle age. Don't necessarily build up the next generation of their firms as at the outset like we should. You start to see that with a lot of firms where there's this seeming gap between the GPs who are approaching their late 50s, and then they suddenly get religion on next generation, and they hire people in their early 30s, and it's just too large a gap between those two groups to impart the knowledge as colleagues rather than the mentorship, like as like teachers. So you see this problem where firms seem to fall apart. Like there's no multi-generational firms where they haven't been hiring somebody who's 10 years younger than them to come in at an earlier stage. And if you look at Sequoia, you look at Kleiner, you look at others, they've all been very good about very quickly within fund 2 or 3 lining up the next level of GPs that they'll be bringing in. And sharing those economics, or making those economics less painful to endure at the earlier stage of their careers. So to build a brand loyalty, and you can see it with Sequoia. They've just been much more thoughtful about making sure that those younger, potential GPs can essentially buy into the firm as they go further.
Got it. Yeah, that's helpful. And then, let's talk about just an edge, right? We have so many fund managers out there in the world. There's so many climate funds. There's so many fintech funds. There's so many B2B SaaS funds. There's so many AI funds, right? So how do you make yourself different than all the others? And what have you learned in terms of storytelling? To kind of engage people, because I feel like with everything, storytelling is the most important.
I agree. Like
when it comes to fundraising, everything.
Well, the stories need to be true, or at least pass some level of due diligence. So that's probably something we should mention at the outset. I hear a lot of stories that I know are not true.
So just a fun anecdote. Sorry to interrupt you, but the movie Catch Me If You Can.
Yeah.
So none of that actually really happened. Like I actually saw the story about the real person, and there was a guy that just kind of was delusional, and he just told all these crazy stories about how he faked being a doctor, faked being a lawyer, and none of that really happened. But he ended up started to create like seminars, and people just loved his story. But the problem was it never happened. But he still got like a Hollywood movie. Leonardo DiCaprio.
There's two ways to look at that. There's none of it really happens. Should we draw any lessons from it? Or actually, should we draw the lesson that the whole movie had anyways, which is you can't trust anybody unless you verify their stuff.
Sure.
The movie was about, hey, you can't trust this guy because everybody sort of like will just naturally take it on spec, right?
Sure.
And then we find out that the movie's fake too. Like, isn't that like the best lesson from that movie, right? Sure. I found that LPs, particularly institutional LPs, have difficulty checking and figuring out whether or not what they're hearing from the GP is in fact the story as it should be told. It can be a story that's plausible,
sure,
but not necessarily the story that is the truth.
Yeah, I will say too, there are some institutional size families that hire private investigators,
and you'll find that there are firms scattered across North America and Europe that sole job is to do the due diligence on LPs. Sometimes they catch something. Very often, it feels like they don't. But I think if you're planning on continuing to, at some point, it comes out. Like it's one of those awkward moments where it comes out, and I've seen this happen to LPs suddenly realizing that they've gotten into bed with somebody with a reputation or a background they would rather have not have, and it kills funds. and it kills people's careers. So, what do you do? And I think from the outset is radical transparency about what you're really about, and what has not gone wrong in your careers and in your investment cycles previous to what you're doing now. If you're trying to sell yourself, obviously you're going to tell them the best story going forward. But there has to be a level of vulnerability and frankness that you continue to do. Otherwise, you're going to find yourself one day, feeling as though you've misled somebody into the relationship. Which is not, if you're comfortable in the reasons why you've done things in your life, and you're not gaslighting people, you should be fine. Right. For me, like the sales pitch to entrepreneurs is pretty simple. Every deal I do raises 2 subsequent rounds. I'm not interested in a quick exit. My goal is to set companies up at the seed level for their Series A and Series B raise, and that's usually when I start exiting the board. So after the Series B, you'll rarely find me still on the board.
Sure.
And because that's where my value add ends. And I exit companies in the periods after that. For the LPs, it's I'm bringing an institutional level of oversight to seed based deals. I lead or co-lead all my deals. So I'm usually anywhere between 35 to 50% of the round in the seed, and I build structure, and it's not du jour necessarily. You see a lot of sort of $250,000 safe checks going in, and call us when your next round happens kind of attitude. I'm a more convictional investor. I'll do 6 to 8 deals in our fund. And our fund will do 20 odd deals, amongst the 3 of us. But we're very, very focused on bringing value add to management and taking that first customer and making 30 or 50 out of them. Right. So
when I've seen the more concentrated, high conviction portfolio construction strategies, I've also seen a pretty high amount of follow-on as well. So do you agree with that too? Yeah.
Sort of. Like history has taught me both views. Like the ones where
I've seen like 45 to 50%.
We've used 35 to 50. I think we've modeled up to 50% as our top line on it. We've had 2 or 3 sort of views on it.
Yeah.
But the goal, really, if you have conviction at the early stage, you're trying to get your ownership there. Your follow-on is merely to show conviction to the follow-on investors that your time with them has been like, you have views that this is the one that you want to continue to run with. So you're showing conviction to the other investors who are coming into the Series A, and recognizing that your money's at play there as well. So that gives them a level. We'll be tapped out, I would think, 90% of the time by the time Series B shows up.
Sure.
And if anything in the last 5 years has taught me anything, that it's always healthy to take a secondary where you can. Right. So, and I kind of knew that before, but I think that got reinforced over the last 4 or 5 years.
Sure.
It's just taking your initial deposit in the company off the table.
So for the audience, just to clarify, when you say taking the secondary, you mean, selling some of the secondary shares and offering that as well to some of the LPs to get into pro rata rights as well.
So our goal, our intent is that for our institutional players and our corporates, that where it makes sense, that at Series B we'll be offering up the either our pro rata opportunity, so we can transfer it into an SVP, like into a like special purpose vehicle. Or we would secondary some of our shares either to the incoming investors or to our colleagues who continue to want to go forward.
The
idea is to sell between 25 and 50% of our ownership, if we can.
We can offer some liquidity back, and
offering healthy liquidity and letting some ride, and not at the same time not necessarily doing that to the detriment of the fundraise that's going on. Like if there isn't that, if the temperature is not to get that done in that round, then I'm not going to be jumping up and down to sell shares. The goal would be to, if it makes sense for dilutive purposes to find some secondary, we'd be willing to raise our hands, right?
Also, so there's not a tax impact. Many LPs prefer to just recycle. That way, they can just kind of recycle it back into kind of
Yeah,
the next
that's
opportunity, the next fund.
yeah. But depending on where you are in fund cycle, you'll have that recycling might not necessarily even hit the as yet invested capital into the
Yeah.
company, right? So you're really trying to just get them back to 1-to-1 so that everything
Hmm.
else is gravy. And there are, depending on who your LPs are,
Yeah.
some are more focused on tax issues than others,
Hmm.
right? Like,
Sure.
depending on how they structured the investment into your firm or others.
Hmm.
In Canada, there are mechanisms to reduce the tax rates
Yeah.
for those if you wish. But you have to be cognizant of the fact that, like, you can't I can't run a fund thinking about every tax implication for every type of investor I have. Like,
Sure.
it just doesn't work.
Yeah. Absolutely. I mean, I think one goal to have possibly is, I mean, for everybody is definitely getting into DPI at some point and just kind of really thinking through when that could happen.
Yeah,
And
driving DPI, like, it's a much easier conversation every quarter with your LPs
Mhm.
if there's a DPI, at year 3 or 4 is beginning to trend in a positive direction.
Yeah.
Obviously your biggest winners are not coming due in year 3 and 4. They're
Oh,
usually
sure. Yeah.
they're usually the ones that just exited faster than you thought they
Hmm.
would, right?
Yeah. No, absolutely. For the emerging managers, I think they benefit from your insights on just how do you source amazing founders? What are kind of the platforms in your machine that help you source great founders? Is it, do you have your own community? Do you partner with other fund managers? All of the above. And then the second question to that is, what is your filter? What is your process to kind of see if somebody's a good fit? I know some of it's qualitative, some of it's quantitative,
Yeah.
but maybe if you can unpack both of those things, that'd be
So
helpful.
finding entrepreneurs for us is not difficult.
Hmm.
The community is pretty small in Canada,
Yeah.
and I should probably mention our fund is, perhaps 80% Canadian focused.
Hmm.
But there are lots of great, if on the AI front for us, there are lots of great, programs around like all the universities, and
Hmm.
we're plugged into all of them.
Yeah.
I'm an advisor to 3. I think David has me beat by 1 or 2. So
Sure.
he's there, like more often than quarterly, probably
Hmm.
every month or so.
Yeah.
Um, so we see a lot of great talent coming out there. We
Mhm.
also have, like, I've been, as I said, David and I have both been VCs at separate firms for 20 years. So we both have networks that transcend our time together.
Mhm.
So we've got return founders or the staff of companies we invested in previously or now
Yeah.
spinning out. So that just allows us to get access to them that much earlier. Um, how we gate it quantitatively, is people we want to work with, and and, like, generally speaking, people who, when they hear the pitch about us building a system, taking a big chunk of the money to put into their fund, that self selects a lot of entrepreneurs in or out. Like, some
Mhm.
people don't want me sitting on their board,
Sure.
giving them advice
Mhm.
or practical experiences that I've had working with others to share with them. They would prefer to do it without that. Um, and if they do, that's great. They weren't a fit for us. Like, I'm not going to wedge myself into their businesses to try and give them advice when they don't want it.
Sure.
And that's and every failure I've been a part of has been founders that I think chafed under having a board or having professional investors, to answer to quarterly
Mhm.
or more often than that.
Yeah.
And so, those are just not people who are wanting to work on this problem together in the same way I need to
Well,
work.
you answered this question a little earlier too, because I think what you mentioned too is what you offer is kind of a structure,
Yeah,
and I think that process and infrastructure and just best practices is definitely needed for anything, right? So I mean, I
yeah,
think
I like to think so, but not everybody believes that. Like,
yeah.
there are the majority of
Mhm.
seed funds today are focusing on doing but much larger amount of checks than I am.
Yeah.
With our fund is targeting 50 million,
Mhm.
um, US. that sort of, you can do the back of the envelope math when I say sort of anywhere between 20 and 25
Yeah.
deals. You can sort of figure out, and not all of them are going to get follow on, so you can sort of figure out how that's going to work.
Sure.
But if you're a $50 million fund and you've done 30 deals, I don't think you have the wherewithal or the capacity to manage those deals as directly as I'm talking about.
Oh, right? Yeah, there just isn't the bandwidth to do that.
Yeah, and so that leads some founders to think that that is the mechanism they'd rather go to, right? Somebody gives them a check, has a network that they can call into once in a while, and that's about it. That's fine. Sure. Like that's for each founder. There's a different way of doing things. There's no one. If this was like an easy plan, then go for it.
Yeah.
But for a lot, I found my career just when I see the sort of what I would call the check without necessarily providing advice or getting involved, it doesn't go very well for me.
Yeah. So along with the structure and the support that you provide, what else categorizes being someone who you want to work with? Like what else are kind of some of the maybe things that you feel or kind of the vibe that has been the common thread across?
I'm a big fan of them negotiating me hard.
Okay,
I've noticed
that's cool.
the harder the founder negotiates my term sheet, not necessarily unreasonably, but like reasonably, the better I feel about them, because don't forget in the next round they're going to be negotiating against somebody else for me because I'll be an owner by then.
Yeah.
So I want a founder that A, knows how to sell to me.
Oh, sure.
And B, knows how to like negotiate with me without losing me during the process. Right.
Yeah.
And so I'm, I don't put a term sheet on the table without the intent of actually that's the term sheet I really would like. But if they can move me off that,
sure.
I or convince me why there's question marks about what they think it is, but structure, value, and total investment size, whatever. It's just very interesting for me to see how they feel the levers of their business are working in the context of a capital raise, right? And then there's also when I with the network that we have here, if I bring them talent, how well they do at convincing that talent to join them at an earlier stage. Very often we meet founders probably a few steps before we would be able to invest.
Yeah.
And they ask for help. And we're happy to help, but what kind of help can I give you other than capital when we're not ready to give capital? It's usually network, right? And how that network interacts with them and how well it goes gives me a very good sense of whether or not this is going to work for us if we were to make an investment later. So it's very insightful to see if they can sell talent as well as they've sold capital.
Yeah,
it's not as though we're the talented ones.
No, that's what's super important. I mean, just getting the right people, being able to poach people, right? I mean, good people usually don't get recruited; they get poached from their competitor, ideally, right? So I think if you can kind of tell people your vision successfully and have those people come aboard, I think it's one of the most important. I mean, look, I agree. I mean, sales is the most important skill. I've mentioned this hundreds of times. I mean, and it's important for everything, right? Even if you're in college and you just want to get a job, I mean, that job offer is a sale. Right. I mean,
absolutely. And I think that's where founders, particularly the engineers we're going back to earlier, that's where engineers fail the most, is translating their technical skills into a sales skill. That usually takes some good learning and coaching and feedback. And I don't know if you can do that in a vacuum.
Yeah.
Right.
What are some of the biggest learnings that you would take away from Q1 or maybe even from last year?
From last year, silliness is alive and well in our ecosystem. I kind of felt that the 2002 moment was going to teach a lot of the newer generation of GPs. You saw everybody sort of pause for a moment and reflect. I'm not sure if we saw the reflections actually be absorbed by the majority of the market. There's a lot of what I would call high value companies that with low revenue multiples, and they're looking for exits and they've raised huge amounts of capital, but I just don't see how they deploy that productively in the short term. So there is still silliness going on in our market in 2023 and into perhaps 2024 as well. It seems to be slowing. I'm not sure if you're seeing it down south as much, but up here, the market outside of AI has slowed significantly.
Yeah.
but still within AI, you're seeing the silliness going on, and sort of it's kind of a tale of two cities going on.
Sure. I mean, I'm seeing, I'm in New York, right? So I'm
Yeah,
seeing an increase in activity, which is kind of exciting. I'm seeing an
that's good.
increase in LP engagement. So
Yeah,
I see people coming back in. Obviously, the summer is around the corner. So usually, New York, everyone, is in the Hamptons
yeah,
and away for the summer. So I would say, like, people that are trying to raise money, whether it's fund managers or founders, expect a little bit of a lull, probably over the summer. And then I think there's like one last sprint from like maybe August till November.
yeah.
And then it
LP
just
LP
becomes the
deployment
holidays.
seems to be down significantly on the Canadian side of the
Mhm.
agenda, and internationally, that's like if the domestic capital usually leads the foreign capital coming in. You don't see them in
Yeah.
the first rounds. You see them in the
Mhm.
second and third court closes. And we're just not seeing a lot of a lot of local capital being deployed
Mhm.
right now. Still,
Yeah.
you hear about it, but you don't see it. So I'm not sure if that will lead to further issues down the quarters.
Sure.
But it's I've noticed that on my US side, yeah, we're getting a lot
Mhm.
more interest there, and
Yeah.
it's that which is great, but harder
Mhm.
to crystallize when you don't have those earlier
Oh
closes in the
yeah.
Canadian market.
Absolutely. And I would say too, I saw an interesting post the other day. I think it was one of the GPs at Harlem Capital.
Mhm.
They were just talking about locations. So the locations that they're hearing a lot more, I believe it was New York, San Francisco, Miami, and Dubai. Those are like the
Yeah,
four locations where I think a few months ago people were talking about Austin, like kind of the tertiary cities.
yeah.
So it's interesting to hear Dubai kind of
I was
pop
there.
up
I
a
was
little
there.
more.
I spent a month there. I was in Abu Dhabi, but
Yeah.
right next to Dubai, for about 4 weeks back in January.
Yeah, I,
Um,
I actually had dinner with a GP like 2 weeks ago,
yeah.
and the next day they were flying out to Abu Dhabi. They're meeting some kind of sheikh or something like that. So tell me a little bit about, I know we got like 3 minutes left, but any top level insights from Abu Dhabi and why people are talking about that, or what prompted you to go there?
So my wife was my wife's the founder, and she had some investors out there.
Okay.
And so we have a young child, so we decided to make a trip out of it for
Oh,
3 or 4
sure.
weeks, so that her 1 week trip wasn't sort of in and out. And
Yeah.
and a lot of Canadian expats or locals who came to Canada
Hmm.
for their master's and PhD degrees. So there's a lot of Canadian to connective tissue into the Abu
Yeah.
Dhabi and Dubai markets, particularly the sovereign wealth funds,
Yeah.
um, but also in the tech community there. And
Hmm.
so it just made sense for me to go there, I was there 6 months earlier as well. I go every 6 months. So
Oh, wow.
well, we have a visa
Sure.
for Abu Dhabi. But what have I learned? They're feeling like that they've got some issues with the local market. So
Hmm.
there's a lot of activity there, but it's focused on making activity happen there.
Yeah.
So if you're like me, like a GP in Canada, you're trying to get money,
Hmm.
or in the US, I think you'll find it more difficult to try and get that money and to go back to the US with that capital.
Hmm.
If you're talking about working with them on their local community and ecosystem issues and wanting to build the ecosystem there, they're much more receptive to it.
Yeah.
Um, and it takes time. Like you
Sure.
can't go there, raise around and come home. Maybe
Yeah.
you can if you're coming from a brand that's well known, but if you're like me building a brand from scratch,
Hmm.
you're gonna have to like continue to put in face time and relationship building there. There's a term there called WhatsApp, which is like
Hmm.
short for WhatsApp.
Yeah.
And your is your cred. Like
Sure.
how's your network ability? Who do you
Hmm.
know? How can I check up on you to make sure you're
Yeah.
credible? It's a very international network.
Sure.
So if you've done a master's degree or you have a university education from a certain place,
Mhm.
you really should dig into that to see who's there to help you
Yeah.
to integrate yourself into that
Mhm.
ecosystem. And you'll have to go back and forth multiple times to build those
Yeah.
relationships. But they're not deploying capital out,
Mhm.
except at the very high levels, like
Yeah.
$150 $250 million checks, which is not my
Sure.
world. They're much more focused on how can you come and help us build something that's going to be here post oil and gas world.
Yeah.
That's what they're
Sure.
focused on right now, and you see
Got
it.
it.
And Saudi is now doing it at a much higher like rate.
Yeah.
And it's just, it's an order of magnitude like larger.
Sure.
So that's also beginning to make itself felt there locally.
Great. Well, hey, Matt, this was amazing. I mean, the time flew by. I really had a lot of fun.
Yeah.
And
Pleasure
we covered a lot, so enjoyed hanging out. And, give me a ring when you're in New York.
Yeah, I'll come to Toronto.
Yeah, I could do that too. One of my buddies from Toronto is coming in this week, so I'm due for a trip at some point.
Maybe I know. Who is it?
He's a psychiatrist, so maybe
hopefully
I don't know.
I might need to know him in this business.
Yeah, different sector, but old buddy from college.
Yeah, for sure. You should definitely come up though.
I will. I'll be up there. We got we know Matt from Ripple, and a couple other buddies out there, so we'll definitely do something. Cool, man. Well, thank you so much. Catch up soon.
Well, pleasure. Thank you, Joel.
All right. Take care. Bye.